Well, that was halftime committee member Jim Lebenthal on Intel's quarter. That stock sinking on a double-digit revenue decline. And it looks like the other big chip names have managed to hold up pretty well today. So is this really an Intel problem, or should the rest of the semis brace for pain this earnings season? Let's ask Douglas C. Lane managing partner Sarat Sethi. Joins us now on the Newsline. I appreciate you joining me. I mean, you've got, NVIDIA and Qualcomm. Are you worried in any way as a result of what you got from Intel?
No, I think this is very specific. Jim hit it on the head. They also, pulled in all this inventory that we had during COVID. That affected their earnings, and I think the demand there that was totally miscalculated on PCs and even data centers. I think NVIDIA and Qualcomm are very different animals. They're also much higher-end chips, higher gross margins. NVIDIA has to also be a little bit careful just because they do have the data center. And Qualcomm, of course, we can tell with Apple and Google in terms of really the semiconductors that go to chips and auto production. But I think it's a very different animal. I think we're going to have, this is be hard sailing for Intel for a little while, and it could also affect other commodity chips as well.
But you don't think, even I'm just thinking of maybe a more Qualcomm than NVIDIA, if you were concerned about either of the two. If you're thinking about where the economy is going from here, handset sales, demand, things like that.
Less, Qualcomm, yes, but also Qualcomm doesn't produce their sets, so it's all IP and royalty for them. And they've also, if you think of kind of where Qualcomm trades, it's, 12 times earnings. It's already been hurt with some pain. They have a lot of cash on their balance sheet. I think it'll be a little slow for the next 2 quarters, but you're really buying Qualcomm for their IP that they keep on creating for the chips that go into phones, cars, and a lot of the 5G.
Yeah, I want your opinion on something Professor Siegel told me a short time ago, and I don't know whether you had a chance to see it or not. Asked him about this rally in tech to start the year, whether he's a believer in it. And he said, well, he totally understands why tech has rallied, but that he'd fade it. What do you make of that?
Yeah, Scott, I've been talking about this for a little while. I think tech has been overbought, even at these areas. We've been cutting back our tech, even for some of the high value companies there, just because the P's in the 20s and 30s are still pretty high. And I think people will find other areas to put money in, especially as we're getting a slower economy. All the indicators are showing we're getting a slower economy. So I think multiples will compress. And unless you have super growth, it's going to be very hard to sustain some of these multiples.
Wow. So when you say 20s and 30s, you're not talking about, these crazy higher flying tech ones. You're even referring to some of the mega caps that are in the mid-20s.
I am, and cutting back my exposure to Microsoft and some of the others. I'm just not taking the market weight that they have, because I do think there's other potential, and I think there's more downside to these, especially when the market kind of pulls back, because that's going to be the source of funds. That's where investors are going to get capital.